Do you want to pay more in taxes than you might have to? Hi, I'm Matt Goolsby. I've taught hundreds of classes over the past years, and I've not once had anyone raise their hand and say, yes, I'd love to pay more in taxes than I really have to. We're going to talk about the different pitfalls we'll see, and maybe even you could classify them as mistakes pre-retirees and retirees make in retirement. We are very big on education. We've got a lot of classes you can watch, whether it's at retirementhelp.com or marketadvisorygroup.com. We'll also teach in-person classes across the metro, but go check out this educational resource for you to stay up to date on all the things that could impact you on your retirement. Got to get the disclosure out of the way. None of this is intended to be legal, tax, or financial advice. We're going to talk about several stories today, and they'll all be hypothetical in nature, but they come from real-life accounts that we meet from people that, just like you, that come to either our classes, watch these webinars, or listen to us on the radio, and of course, watch our weekly television programs. We work together as a team. I'll mention this several times through the class, but as a financial advisor, it takes more than just me to help people stay on track in retirement. And I have to often rely on our tax advisors from Market Tax Services, our healthcare professionals at Market Medicare Advisors, and of course, our attorneys that work alongside with us at Eidelman Law Firm. All together, and I'll talk more about how you can get your Core 4 report towards the end of this webinar. Now, there's different types of taxes that can apply in retirement. Social Security has its own formula, and we'll cover that briefly today, and this is one I find oftentimes surprises people the most, and not in a pleasant way. Regular income taxes, you cannot avoid those, and oftentimes I think there's signs that point to the fact that taxes could be higher in the future. Interest income, well, with this Social Security formula, I'll find that if you have CDs or money markets, and you might not be fully aware of all the taxable implications that could be hitting you from that interest there, if you're not needing it for income, and we'll talk more about, there's some different strategies you can talk about with us later there. Capital gains, not going to get into that much today, but sometimes these different pots of money can have different tax rules. And of course, those retirement accounts, they're basically ticking time bombs for tax purposes, because you have to take money out when you turn a certain age, whether you need it or not. But I want to stress this. I'll end today's class with a strategy that we engage with our tax advisors to see if it's wise to take some of the money that's pre-tax and pay the tax today and move it over to the tax-free account. Because tax-free, that sounds pretty good, but really what I want to stress today is tax-free can actually help you save money, not just today, but in the future. Now, I mentioned earlier, various sources, or sometimes we call them different pots of money, can affect you both in beneficial ways, but also in negative ways. But the point I'm trying to make here, I want us to drive home, is if you're not sure of what's happening in the background, it can cost you big time. But I find there's two areas that often overlap and they don't normally play very well together, and that's Social Security and these retirement accounts. And if you're going to have those two things in retirement, you need to be paying attention, because you don't want to have these costly mistakes happen to you and find out after the fact. We're doing this class to hopefully help you avoid these costly mistakes in retirement. So let's talk briefly. I believe in looking to the past to see if we can maybe get a glimpse of what might happen in the future. Another way to say that is oftentimes history can repeat itself or sometimes rhymes. And I think taxes will be higher in the future, and you want to consider these retirement accounts as potentially ticking time bombs and take a look at maybe paying some of the taxes on that money now while taxes could be cheaper, but then saving yourself the heartache in the future when taxes could be higher. So what will our future tax rates be? Well, to get an idea, let's take a look at the history. And I'm going to show you the tax history of the United States, and we're going to show the national debt with the top tax bracket. And interestingly enough, when the income tax system came out in 1914, the highest tax bracket was 7%, and the national debt was just $3 billion with a B. And I think that's correlated to one another, not always directly, but I believe the national debt and the top tax bracket do have some relation. And we don't have any idea what high taxes are. Because after the 1920s, when the Great Depression happened and the stock market crashed, the Dust Bowl, the government had to put us all back to work, and that had an expense to it. And the highest tax rate in U.S. history so far is 94% in 1944. Now you can see tax rates shoot up there at the end of the 20s. And in 1944, the national debt was just $200 billion with a B. Of course, taxes have come down, and recently with the passing of this One Big Beautiful Bill Act, whether you like it or not, there are some, I think, advantages in the tax code that you should be taking a close look at with a tax advisor before the end of the year to see if you can optimize your situation or take advantage of these tax maybe breaks or lower tax rates to lock in some benefits for you later on down the road in retirement. But the top tax bracket right now sets at 37%, and it's set there since 2018. Speaking of 2018, when the Tax Cuts and Jobs Act was signed into law, the first term of President Trump, the national debt was $21.5 trillion. Now, $21.5 trillion, that sounds like a lot of money until you fast forward to today when the national debt is over $37 trillion. I will long firm believer in talking about, I think, the next 10 to 15 years for you watching this class, some things that are going to be important to consider are taxes, inflation, and your healthcare costs. And again, I think inflation and your taxes directly have a correlation or a close correlation with the national debt. And I think, yes, we might have taxes lower right now, but I don't know that they'll always be that way. And I'm concerned for people that have these monies only in pre-tax. And I'll get into some examples here where I'm going to show you when people go to take a withdrawal, it can sometimes cost them more in taxes if they don't have any in a tax-free retirement account. So now let's talk about the formula for how they determine if your Social Security will be taxable. It really depends on how much other income you have in addition to your Social Security that you're receiving. Now, it's a pretty high chance if Social Security is the only income source you're going to have in retirement, you might not be taxed on it. And it's just how the current system's set up. Now, last year when we were watching the candidates on the campaign trail, we heard Trump talk about the fact that he wanted to eliminate the tax on Social Security. Well, they didn't quite get that done. And I'll cover here some of the extra features or the senior bonus deduction that was included in the One Big Beautiful Bill. But for right now, this formula still applies, and I find it catches a lot of people off guard because it's just not black and white. It's not an easy formula to understand. Worse yet, most people don't even realize it works to their detriment until they get a high tax bill when they go file their taxes in the next year. So let's take a look at the ingredients that go into this formula. It's not unique to governments to have, formula ingredients and then the formula itself. So the ingredients that go into this formula are half of what you're receiving in Social Security benefits, then ordinary income, dividends and capital gains, and non-taxable interest. And after you have those ingredients, they then say, well, are you single? And then there's 3 tiers. Once half your Social Security and your other income as an individual goes over the $25,000 threshold, then you could start having some of your Social Security become taxed. Again, it's just all this confusing formula, and it really depends on how much is there as far as income is concerned and what type of income it is. Once half your Social Security and your other income as an individual goes over $34,000, now 85% of your benefits could be subject to taxes, okay? Now, they don't double those numbers like they do with income tax brackets, but for married filing joint, they do increase the threshold. 32,000 is the threshold. 32 to 44, half of those benefits could be counted as taxable income. And of course, after 44,000, 85% of the benefits that are falling in that tier could count as taxable income. I've always got to watch my words really careful when I'm teaching tax classes because this can mean that, and something over here can have an impact over here. Now, I mentioned this, so I want to recap this one more time before we go into our examples. This is often contingent on how much other income you're going to have in your scenario, and when you have other income, you can push yourself. I consider it almost double taxation. We'll get into that example here with Mark. So this is Mark, and he taps his retirement account for just an extra $1,000 for a road trip. Now, how much tax will he owe on this $1,000? Well, it's going to depend on a number of different things. Remember that Social Security formula? And that's before we even get into income tax brackets, which we'll check in on in a second. So when he takes this $1,000 out, we have to take a look at what his other income is. Well, his taxable income is $32,775. But he's taking $38,000 a year before he takes this $1,000 extra withdrawal out of his retirement account, and it's all pre-tax. And I want to emphasize that, pre-tax. So he's going to owe taxes on all of it. In addition, he's also receiving or collecting $25,000 in Social Security benefits. So, you can see here that if this Mark in real life, he's not really a billionaire, as the picture might suggest. And again, these stories are very applicable in real life, and we've seen instances where this can catch people off guard. I put pictures up here to give us a face with the name, but this is not in the real world where this Mark being a billionaire. You can see his income, $38,000 plus $25,000. His total income, $63,000. Now, if we're going to try and figure out, well, how much should Mark withhold on this $1,000 withdrawal? We got to take a look at, where he's at with his taxable income of $32,775. The tax brackets this year, Mark's single. Well, it looks like he's falling in this 12% tax bracket. But one of the things that oftentimes people will overlook, maybe another way to say is they're even completely unaware that's going on in the background, is this Social Security taxation formula. Now, before we go in and show you the results here of what Mark will really pay, I want to take a time out here and talk about how do income tax brackets work. Well, we call them tax buckets. And I use that metaphor because I think it resonates more with people than brackets. And if someone's in a 22% tax bracket, that doesn't mean all their income is being taxed at 22%. It means some of their income was taxed at 10%, but when that tax bracket or bucket was filled up, then the overflow that spills into the 12, then those dollars start getting taxed at 12%. And then when the 12% tax bracket's filled up, then those dollars that are falling into the 22% bracket or bucket, they're being taxed at 22%. Now, Mark, he might look like on paper that he's in a 12% tax bracket, but I'm going to show you because of the Social Security formula, he's actually in a 22% tax bracket. How? Well, I'll show you here in just a second. But I want to point out this one big beautiful bill that they've passed. They've said they've made these tax rates permanent, right? Well, permanent to me, AKA, otherwise known as, well, that's just until the next guy or gal or president or Congress, whoever, decides to change them. And remember, I've showed you, we have a spending problem in this country. We have a problem with our national debt. Taxes, in my opinion, I don't think can stay this low forever. We're going to have some serious challenges here, and the ones that I think will pay the biggest price are the ones that have only saved in the pre-tax retirement accounts. So now let's take a look under the hood what happens to Mark here. Well, he thinks he should pay the 12%, and if you'll notice, the only physical change here in his income is just $1,000. I want to pause on that just a second. He's only collecting an extra $1,000 out of his accounts, or an extra $1,000 of gross income. But it changes the taxation on his Social Security. So not only does he owe 12% on that $1,000 withdrawal, but he's already in that top tier, the 0%, 50%, 85%. He now owes another 12% on another 85% of the $1,000, which totals, for a combined total here, he needs to add another $1,850 to his adjusted gross income, taxed at 12%. That means he owes 22%. Now, when do you think Mark figures this out? Unfortunately, we see it all too often. If you're not getting tax advice with your investment advice, people find out this costs them extra money when they go file their taxes in February, March, and April. But to me and the rest of the world, that's typically too late to do anything about it. And if you want to subscribe below and you'll catch more classes that we come out with these topics so that you can help avoid the mistakes and these pitfalls happening to you. Now, how do you know what you don't know? Yeah, we search the internet for when we have questions, but have you ever searched the internet for, hey, what do I not know that might hurt me, that I need to know about? It doesn't work that way yet. So let me share with you another story about Walter and Jane. They want to take a trip to Europe. They're retired. They've saved, they've sacrificed, they've put aside this money to enjoy this time. And, they've got a pretty decent income. They're taking $110,000 gross out of their retirement accounts every year to supplement the almost $41,000 they're collecting in Social Security benefits. So if they take an additional $10,000 out, how much in taxes do they owe? Well, you have to factor in, again, this Social Security formula. And they only have pre-tax retirement accounts to draw from. Now, could they benefit if they had a tax-free retirement account? We'll talk more about that as we go through this class. But taking a look under the hood here, they're starting to now hit the phase out where they're not even going to get to benefit from the over 65 bonus senior deduction. So now they've pushed themselves where the phase out for a couple this year is over 150,000 AGI. It starts hitting that phase out. They don't get to benefit from that $6,000 senior bonus deduction for both of them since they're both over the age of 65. And when they take this $10,000 out, it doesn't cost them 22% in taxes like they might think it would. It actually costs them 35%. Now, when do you think, again, Walter and Jane figured this out? Unfortunately, when it's too late. And I mentioned this earlier. What if they had a tax-free retirement account that they could draw from? It would save them up to $3,500 in taxes. But most people will only have all their retirement nest egg savings in these accounts that have not had the taxes paid on them. And that can spell trouble down the road, especially if you've done well saving for retirement. And we'll talk about a lot of times how retirement can be disorganized or basically no coordination. And the responsibility all falls on your shoulders to go find these different financial professionals to get advice on these gaps or maybe these areas you don't have addressed in your retirement plan. So you'll meet with, most often, typically the financial advisor. But maybe you don't have one. Maybe you work with a bank or you still have your retirement with your old 401k. If you call up that person, firm, or company and ask them, hey, when I take a withdrawal, how's this going to change the taxation on my Social Security? Oftentimes, they won't know. They'll have to refer you to someone else. Or maybe you have questions of, well, do I need a will or a trust? I want to make sure that my assets pass outside of probate. The financial advisor, the bank, the firm, the 401k company, they can't help you with those answers. So they'll refer you to someone else. And then you have to take your situation and everything and go explain it to a different professional. And that means oftentimes you've got to become the expert in your circumstance for the technical terms, the details, the nitty-gritty. And then I mentioned oftentimes you don't get tax advice with that person. And then if you're over the age of 65, you really want to make sure you're getting that annual yearly health review, their health care review, to find out what could be changing in your medical circumstances or even your Medicare policies or even the laws. And this is, again, a very disorganized way to do it because if you haven't caught on yet, do you realize who the only common denominator is here? It's typically the retiree. And that's not their area of expertise. And it's confusing. And worse yet, just like we saw this summer, they changed the laws and things can have an impact on your situation, but most people don't figure it out until after they go file their taxes in February, March, and April. So now let's look at Judy here. Now Judy, she's done pretty well saving for retirement. Maybe she can only live on her Social Security, but she's 63 and she's born before 1960. And why that's important is because, again, they've changed the laws. With the Secure Act 2.0, they've made your required minimum distribution age either 73 if you're born before 1960, or 1960 and after, it's now 75. Well, the Judy in real life that I was talking with, she could only live on her Social Security and a little part-time wage that didn't trigger the Social Security forfeiture amount. Now, she has $100,000, or when we first met, she had $100,000 in her IRA, but I want to stress all this money was pre-tax. tax. Now, Judy, I mentioned she was very thrifty. She could just live on her Social Security. But I wanted to talk to her about hypothetically if her account doubled over the next 10 years. And that would mean that her IRA would grow to $200,000. Well, she was okay with that, but I wanted to talk to her about the tax ramifications. And she didn't really understand what I meant by that. So I brought in one of our tax advisors and had this conversation with her. And we estimated that if her money did grow or double over the next 10 years, that she would have to take out more than $7,000, whether she needed the income or not. Now, we already learned with Mark back in the Social Security formula that an extra $1,000 could trigger or cost up to 22% in taxes, maybe even more. So Judy wondered what she could do. Well, I'm going to show you here in just briefly a second. We talked to Judy in the fourth quarter of every year, and we took a little bit out of her account, and we paid the taxes on them today at the lower tax rate and moved it into a tax-free retirement account. Now, one of the things I want to stress here is if you have these retirement accounts that you have not paid the taxes on, the IRAs, 401ks, 403bs, 457s, simple SEPs, thrift savings plan, capers, all different kinds of accounts out there in retirement that you could have deferred having the tax on. One day, if you turn your RMD age, you will not be in control of your income. Whether you need the money or not, it's going to force you to take it out, and that's going to have tax implications, if not maybe even negative ripple effects. So let's talk about Ted and Jane. They're both age 63. Again, their RMD age is going to be 73. Now, they have $1 million in their retirement account. But again, it's all pre-tax. So when they take any withdrawals out, they're just pushing themselves up further the income tax brackets. They're changing probably the taxation on their Social Security, and they could even cost themselves more for their Medicare premiums. And we'll talk about that story here with Mary here in just a minute. But if they are doing well in the market and their account doubles over the next 10 years, that turns their million into $2 million at age 73, which means the amount they're going to have to take out based on tax law today will be $74,000 plus. Now that's going to wreak havoc with potentially income taxes, taxation on Social Security, and like I mentioned, your Medicare premiums are tied to what your income is. And if it goes high enough, it can cost you more. Now, it can trigger, like I said, higher Medicare premiums, but the one thing I want to focus on is the Social Security tax. Because if you have things set up in a beneficial way for yourself, you can sometimes avoid these higher expenses in retirement. And if your money doubles over the next couple of years before you have to start taking money out, or until you turn that age where you have to take a withdrawal, your RMDs may double, but your tax brackets may not. Subscribe below to make sure you don't wind up like Jane and Ted. This is what I want to talk about with your Medicare premiums. And this is kind of a sneaky tax, or almost a sneaky penalty. And do you notice oftentimes when you've made a mistake and you've either cost yourself more money, or you've had a loss, or you've had maybe a painful experience, that's when you become aware of the problem? We do these educational events, our radio show, our TV show, our books, our webinars, our in-person classes, all to try and help people avoid these costly mistakes before they hurt them. But sometimes that's just not the case. And IRMAA stands for Income Related Monthly Adjustment Amount. Now, IRMAA has to do with your Medicare premiums, and it's an additional premium or cost that some people might have to pay if their income exceeds a certain amount. So let's talk about Mary here and the extra medical costs that she had no idea she could have possibly avoided, but she laid on herself and she found out when it was too late. Well, Mary had lost her spouse about 5 years ago, and she had some rental properties that she didn't want the headaches of dealing anymore, so she just started selling them off. Well, she sold 3 in 1 year and had $400,000 in capital gains. Typically, capital gains rates is lower or more favorable than ordinary income tax rates. But this is just a classic example of how if you're not coordinating your tax strategies or tax monies or pots of money out there that have different tax rules to them, it can cost you. So she had no idea of the tax consequence of IRMAA, and it cost her an extra $5,000 for her Medicare premiums. Now, when do you think Mary would have liked to known this was going to happen to her? Probably before she triggered all this, right? but she had no idea it was running in the background until she got a little letter in the fall, maybe October, November, from the Social Security Administration saying, hey, Mary, you're going to start owing us extra amount of money every month starting in January for your Medicare, and don't worry about that. We'll just take that right out of your Social Security payment. It's just that fast. It can hit you out of nowhere. Who wants to have a surprise expense to them in retirement? So that's why you need to like and maybe even share this class with your friends to make sure they don't have these nasty surprises hit them out of the blue. So remember these tax brackets or buckets? One of the strategies we'll use from taking pre-tax money to tax-free is asking at the end of the year, are you maximizing or are you maybe even missing out on opportunities before December 31st rolls around and the close of the tax year happens? So you remember how the tax brackets work when dollars fill up, they spill over, and then that next bracket, we'll oftentimes find people are not using all their tax brackets, or remember we call them buckets, to maximize their assets for them throughout retirement. So let's talk about the difference between a Roth contribution and a Roth conversion. A Roth contribution, you have to have earned income for. You have to still be working a job. Or if you're married and you're filing joint, you can potentially add more tax-free money in, but I want to highlight the difference between a contribution and a conversion. To me, there's two big differences: the amount you can do and the time of year which you can do them. A contribution, like I mentioned, this year, if you're over the age of 50 and you have earned income, you can contribute up to $8,000 into that tax-free retirement account. But there's some catches. If you have too high of an income, you can't do that. And if you don't have any income, you can't do it as well. Now, one of the neat things about a Roth contribution is they give you up until April 15th of the next year, when your taxes are due, to make a Roth contribution for the last year. So again, in 2025, if you're over the age of 50, you can make that $8,000 up to Roth contribution up till April 15th of the next tax year, 2026, for the year 2025. It's kind of neat. There's not a lot of things where the tax code will let you do something outside of the year. But Roth conversions, there's no limit on them. You could do $1 trillion Roth conversion if you wanted to, and believe me, the government would love you to. They'd love for you to pay the taxes on that pre-tax retirement dollars. But a Roth conversion is where you look at and say, hey, I have $1 million in pre-tax retirement accounts, but I have nothing over in my tax-free bucket to help me control taxes as I age and as taxes will probably increase over time. These Roth conversions, though, they have to be done by December 31st. And oftentimes people are not meeting with their tax people before the end of the year. So how can you make sure that you're maximizing a Roth conversion for your scenario? And the answer is you have to get tax planning. And we do this with our team. We get them together and we take a look and say, Mr. and Mrs. Smith, you had a total income in 2023 of $122,000. Your projection for this year in 2024 is X amount. We think you have $23,000 left in the 12% tax bracket. Or maybe you want to realize some appreciated assets, whether it's stocks or real estate. You need to figure out where that might be before the close of the end of the year. I find too often people just do things and they worry about the taxes after the fact. And that's not an ideal scenario. So when we do fourth quarter tax planning, this helps you identify opportunities and sometimes even potential challenges before the close of the tax year on December 31st. Now, you don't want to wait till December 30th to do this either. So when we start up the fourth quarter, we start taking the people we help and get them, maybe even you'd call it clarity about what's going on in their tax situation. And when you have clarity about what's happening to you or what maybe potential opportunities you could take advantage of to maximize for your situation, you have a lot better job at making decisions, or call it maybe making an informed decision when you get to see your whole picture there at a glance. And could the unknown already be costing you more money in the background and you not even realize it? That's again why we rely on tax planning in the fourth quarter to show the people we help with the retirement what could be costing them money, maybe extra taxes needlessly, but they have no idea about it. We have a Core 4 report. And that Core 4 report covers 4 different areas. The core ones: finances, estate planning, taxes, and healthcare. And we mentioned earlier, oftentimes there's such a disorganization or an uncoordinated effort, and it makes you, the retiree, responsible for making sure all these professionals or all these areas where it can overlap aren't getting missed. And is it possible to save both time and money by collaborating with one team under one roof? Again, these are things we go over in our Core 4 report. You learned today the different Social Security pitfalls, the future required minimum distributions that you'll have to take out when you turn a certain age. Find out more what's going on in your situation. We encourage you to book step 2 with us. Step 1 was watching this class, getting a basic understanding of what the pitfalls and what possible gaps they could be out there in your estate plan or maybe your retirement plan overall. But schedule this in-person or virtual meeting with us today, and that's step 2. And that's where we get to know a little bit more about your situation and what's going on there. It's always okay to tell us no. And sometimes this step 2, it ends with people just getting a bit more of an understanding of where some issues or some dangers could be lurking in their retirement. But if you're not ready to schedule this step 2 today, reach out and schedule a 15-minute chat with us by phone, just again, maybe to get some basic questions answered or just maybe understand a concept here that we talked about today that you didn't really fully grasp. And I want to stress, if you don't have this Core 4 report, are you certain that there are no gaps in your plan and some costly mistake out there lurking, and you won't realize it until it might cost you thousands of dollars in retirement? That's, of course, what we do not want to happen. So like and subscribe for more, and we'll keep these classes coming out, and we've got a lot of other topics as well. You might have seen us on TV. We have a weekly television show called Eye on Retirement, where we talk about these pitfalls every week of where someone didn't realize they had gaps in their estate plan. They weren't getting the tax advice they needed. Maybe they were overpaying for their investments, or worse yet, maybe they had no idea which Medicare or healthcare options to choose to cover them best for their circumstances in retirement. We produce this show every week to make sure, again, we're very educationally focused to help you potentially avoid these mistakes. I host a weekly radio show called Retire Hour. You can go to retirehour.com, but we talk about the ever-changing landscape that is retirement. We've written a couple books. One called The Investor Catch, talks about fees, risk, and who's poised to profit more, you or the financial advisor or firm you're working with. And understand, I run across so many people that are overpaying for their investment advice. And I say overpaying because they're paying the full price for that financial advisor. But again, the retiree, they're the ones that have to relay all this information between their tax person, their estate planning attorney, their Medicare advisor, and the financial firm that's helping them. And to me, that just creates too many areas or too many opportunities for things to fall between the cracks. One of our estate planning attorneys wrote The Inheritance Trap: Common Estate Planning Mistakes and How to Avoid Them. Both available on Amazon, but if you come in and chat with us, we'd love to give you complimentary copies of that. So again, we encourage you to book that step 1 if you're not ready to fully come in, but if you are ready to come in, book that step 2, and we'd love to give you a list of things to bring in to have a better understanding of what's going on in your situation. That's all the time we have this week. Thanks for tuning in. I'm Matt Goolsby.